Let's check in on the markets. It's been another frantic day on share markets today. We're joined by Mousina, who's the senior economist with AMP Capital. Thanks for joining us, Deanna. Where do we end up? A long way down today, last I looked.
It was a pretty shocking day. The market was down nearly 10%, even though the US share market had a pretty good bounce on Friday night. So it was a little bit surprising. Unfortunately, I still think that there's probably some more downside to go as investors try and make sense of quarantine measures, travel bans in place, and the big hit to the economy over the next few months. So I don't think that we're out of the woods just yet, unfortunately.
Yeah, well, obviously the economic impacts here are going to last for many months at the least, you would think. The stock market's been so volatile. We saw a big recovery in Australia last week, last Friday. As you say, that preempted recovery in Wall Street. Do we assume now that the Australian market is leading a global trend here again? Do we expect that, are the indices there, that the indicators there that Wall Street's going to fall again tonight?
The futures for the US share market do suggest further falls there. Australia doesn't tend to be a leading indicator for the rest of the world, so I'm not sure whether this is just a one-off reaction to perhaps signs that maybe we're going to have some school closures here and that we're going to have tighter quarantine measures, which markets think mean a larger hit to the Australian economy. I think that that's probably what the very large market moves mean, rather than the sign that Australia is becoming a leading indicator for the US. For US share markets, we did see some pretty big moves from the Fed this morning, where they cut interest rates by 100 basis points. They announced more quantitative easing measures. It could just be a sign that markets are panicked about the levels that central banks are going to support liquidity in the market and borrowing. However, usually after you do see these big moves by central banks, share markets do tend to get a bounce from it. So over the week, I'm hopeful that share markets do make some sort of a recovery, but it really depends on how the number of cases continues to track in the US. And unfortunately, they're just rising at a pretty fast rate at the moment.
There's a lot of talk about quantitative easing. What's the shorthand explanation for what that is and what effect it will have?
That's just a fancy way of saying the purchases of assets, and by assets, it usually means government bonds. So what the central bank does is it purchases these government bonds from the market. That tends to push down the cost of money by lowering bond yields. And that means that corporates and the governments can borrow at a cheaper rate. And it also brings down the cost of borrowing for households. So ultimately, it makes the cost of money or the cost of borrowing even cheaper. And that usually tends to increase credit growth in an economy, which then leads to some sort of economic momentum. Now, the problem at this stage is that if we are on quarantine and on shutdown, it doesn't matter whether you have cheap money and your mortgage rates have been reduced. It doesn't mean, or doesn't necessarily mean, that you'll go out and spend that money. It doesn't prevent the virus from spreading, and it doesn't prevent the negatives that come with quarantine. But it does mean that when we do have the eventual recovery, then the recovery should be pretty strong, because you do have this cheap cost of money.
Yeah, meantime, a shocking time for people living on retirement savings as well, on fixed retirement incomes. Thanks so much for joining us, Deanna. I appreciate it.
Thank you.